Hello to everyone. My name is Beata, and today I would like to welcome in Asset Liability Management Optimization webinar. I will be going through the different concepts of asset liability management, such as interest rate risk exposure, liquidity risk exposure, and then by the end, we'll go to the techniques of how to optimize the banking book of a bank. First of all, let's start with some introduction. So in this webinar, you have the presentation which will be about 2 hours. Then you have the material, the presentation material, which is at your availability. You can download the presentation after the webinar. You have also some additional reading, which goes through the details of optimization process. All objectives, constraints, functions are shown. There is the example of optimization of the funding base of a bank. And you also can take advantage of this article, this additional reading. In any case, feel free to contact me after the webinar whenever you have any question related to this topic. You have my details here, my email and the website of the company. As I said, let me introduce briefly myself. I'm Beata. I lead the small boutique consulting company in London. Quite recently, I have published the first book with Wiley regarding the asset liability management optimization, where I show exactly how to optimize through the numerical optimization techniques, how to optimize the banking book of a bank. When I'm saying optimization of the banking book, I consider the minimization of the funding cost on funding on the liability side, and I consider the maximization exercise of the income on the asset side of the banking book. So those two, for me, in this presentation, are optimization dimensions. So we will be going through the optimization of the funding base, minimization through the minimization of the funding cost, and maximization of the profitability of your asset. Let me tell you that why this optimization concept is so common. Recently, you have heard many times for sure. Let's optimize the capital base. Let's optimize the LAB, liquid asset buffer. Let's optimize everything in a bank. But what exactly it means? I haven't seen many publications or many exercises performed in a bank where you can come up with the clear optimization process which is embedded in the asset liability management structure framework. And in my view, it should be a must. I would like to refer to some consideration and thoughts which already has been expressed by Professor Murat Chanri many times through his strategic ILM and integrated balance sheet management. He states, and I fully agree with this statement, that the future of a bank is the integrated risk management. So there is this integrated approach applied to the financial risk management in ILM department when we try to minimize the exposure to the interest rate risk and liquidity risk. At the same time, we are trying to minimize funding base, to minimize the cost of funds on the funding base, and to maximize the profitability of your asset. So you can already see how strong relationship in this ILM, strategic ILM, the new trend in a banking which is arising, is with business unit, between business units itself and between ILM. Because quite recently, historically, the ILM was considered on a silo basis. So it inherited all exposure coming from the business units, and it had only the main task was to manage those risks in order to achieve the immunity or close to immunity exposure to the risks, financial risks. Now ILM is evolving. It is no more ILM which has been static and reactive. Here we'll be talking about the new trend in ILM. So the active, proactive ILM, let's call it like Professor Murat coined it, a strategic ILM, which is the fundamental element of a bank, and it is an engine of the profitability. So let's start our webinar. And today we'll be talking about the role of ILM. Then I will walk you through the interest rate risk management in the banking book, and we'll do some quick case study. I will introduce this case study, and then I will ask you to solve it by yourself. Whenever you have a question or you would like to check it, please contact me after the webinar. During the second part, we'll be talking about liquidity, we'll be talking about funds transfer pricing, and then we will go through the optimization exercise, and I will show you how the objective function is built and how the constraints function is built in the optimization exercise. We have quite many slides here. We have 154 slides. So obviously, in the 2 hours time frame, I'm not able to go through it in detail, but I will leave it to you, leave it with you to go through it in detail and to analyze and to raise questions and to write to me. And please let me know if you would like to have any other webinar which is related to any specific topic which you came up with and you would like to tackle. So let's start. First of all, the role of this active management of the banking book in banking industry is constantly growing. This is something which I've noticed and which is a fact. The traditional approach to asset liability management practice, which operated as this active process, following product origination by the customer, facing business, is no longer viable. This is because we have the Basel III and IV era, and we have the margin compression. We have many things which has happened in the industry. So definitely such as negative rates. It is something unusual in banks. And coming from this margin compression, we see impact on the bank's profitability. So for sure, banks has come up with something in order to maximize the competitiveness and maximize profits. Otherwise, the business will not be viable anymore. So we will focus on this emphasis. This session will focus on the emphasis of ILM, which is the all-encompassing discipline, and one that should be at heart of all bankers and particularly executive committee. So this time the ALCO members and the board of directors needs to think about ILM as in a different way. So historically, interest rates were stable and liquidity was readily available to banks in developed nations. So banks focus primarily on gathering assets, and there was increased growth, there was asset momentum. However, in the 1970s, changes in regulation, inflation, and geopolitics led to greater volatility and thus increased risk, which came from the mismatches between asset and liabilities. This led to the development of the ILM unit as a formal discipline, where both sides of the balance sheet are integrated in order to manage interest rate, market, liquidity, exchange risk, counterparty risk, all and capital, not immediately, but later it came also under the regime, under the task mandate of ILM. This discipline, however, remain reactive. So in the nature that in nature with treasury and risk, which had little or no input to the origination or deposit raising process. So definitely it was the silo-based approach as far as business units are concerned. So they were originating, there were no interaction between ILM and business units, which could informed ILM, or ILM could inform the business units what would be the best term of the funding, what would be the best, if possible, the best basis factor, market factor, risk factor on the asset side. For example, should it be LIBOR 1 month or LIBOR 3 months or LIBOR 6 months? What is the best tenor of repricing for our asset side? This is something which a business unit asset center could easily define and improve. The same, because not everything is obviously possible when you are talking about some asset class. You cannot easily change it or adjust it. You have just to compete with the market. But for example, on the liability side, it is quite easy to adjust the funding structure for the needs of the bank in order to make it more profitable. So, as I said, traditionally ILM was defined by 4 main concepts, I would say. The first one is the liquidity, which can be divided by short-term liquidity, which is let's say ease which assets can be converted into cash. So we call it as a liquidity risk or counterbalancing capacity of a bank. And then we have the funding risk, which is the continuous ability to maintain funding for all assets. And this is the term which is related to the structural liquidity, to the balance in the bank between medium long-term asset and stable funding. So the bank needs to make sure that there is sufficient amount of stable funding, which is funding the medium long-term asset, so illiquid asset, and volatile funding, which is always at some extent in the bank, which is limited to certain extent because it's volatile. So it exposes the bank to the funding gap. So it has to be managed carefully. Then we have obviously the term structure of interest rates. So the shape of the yield curve at any given time, which depends on interest rate expectations, which depends on the liquidity preference and supply and demand from different borrowers and lenders. And ILM strategy here would consider how changes to the shape of the yield curve in the short and medium term will impact the bank. And the maturity profile of the banking book. So ILM would report and monitor the maturity of all assets and liabilities to measure and control risk. We know that we have this maturity ladder, which is contractual or behavioral, and the bank which needs to make sure that there is no exceeded maturity transformation, and the funding gap are well managed and are within the limits. Then we have the interest rate risk repricing profile of the bank, essentially the risk of loss of the net interest income due to adverse movements in interest rates or interest rate spread. Interest rate spreads, for example, as I said here, we will see later, we have different IRBB categories. We have the basis risk, and this is exactly what we mean when we are saying this interest rate risk spreads, because they are a different the discrepancy in movement between different risk factor, Euribor 1 month, Euribor 3 months, and they are not perfectly correlated. So if they move by different amounts up and down, it can affect your basis risk of the bank. Basis risk arise from different sources, but about this we'll be talking a bit later. And then there will be separate webinar on the IRBB, which explains in detail IRBB risks, because it's hot topic recently, and IRBB is becoming one of the heavy regulated risks together with credit risk and liquidity risk. This is because it is so important to be well managed. And let's explain before a bit more in detail. So what is in scope of ILM? So you can see on this slide that you have the ILM and capital management. Exactly. There's also capital which needs to be managed under the task, under the remit of ILM. So a key focus for banks is managing capital, funding, liquidity, interest rate risk requirements. And these all, you can see is on the slide, they fall under the umbrella of the ILM. And when a bank borrows more than it needs, there can be inefficiency in terms of capital use. So this is why capital is also under remit of ILM. So this also can also result in added interest rate risk and a loss when lending on. So failure to have a sufficient liquidity, however, results in the bank having to rely on central bank liquidity, poor market perception, loss of investors, which could ultimately lead to failure. So ILM becomes the most important aspects in a bank's risk management framework. And as you can see, all those risks are correlated together. So let's talk a bit about the silo management, which what does exactly mean silo management in ILM, which had been witnessed since 1970s. Consider exactly how ILM is undertaken in virtually every bank today, irrespective of size, business model, location. A business line in a bank following an understood medium-term strategy, which is articulated explicitly or implicitly. In reality, we know that it has to meet the year-end budget target, goes out and originate customers' business and originate assets and raising liabilities, because this is exactly the role of a bank. It would most likely have little interaction with any other business line, and only the formal review interaction with risk department. So, for example, I was quite often, when I in my experience as a ILM manager, I was asked quite often, what is the impact on this particular funding structure on interest rate risk exposure of the bank. The problem was that this funding structure has already been established, has already been defined, and by the end, the treasurer has come up and asked what was the impact on the fundings, on the interest rate risk profile, what is the maturity in repricing gap, what is the exposure yield risk coming from this structure. So it was too late. This process needs to be done simultaneously at the same time. Treasurer, head of interest rate risk in the banking book, they need to sit together and analyze ex ante, what is the impact on the certain funding structure on the IRBB profiling. And unfortunately, this is still still quite we see the silo mentality in the organization, and it is typical of all but not very smallest banks. In some banks, an individual business line may have practically zero interaction with treasury, and each of these business lines will proceed to undertake business as a part of a grand strategy intertwined with other business lines, but in reality, to a certain extent, in isolation. And the action of all these customer-facing desks in the bank will then give rise to a balance sheet which must be risk managed instead of a bank which is proactive and profit-based. And the ILM part of this risk management process is undertaken by Treasury in conjunction with finance and risk in order to have it more integrated. There is still little or no interaction between business lines and little or no influence of treasury function. Instead, in other words, ILM is a reactive, after the fact process. The balance sheet shape and structure is arrived at is not by accident, certainly not by active design, and certainly not as the result of a process that integrates asset and liabilities origination. So the people charged with stewarding the balance sheet through the economic cycle and market crashes have very little to do with creating the balance sheet in the first place. So does it represent best practice risk management discipline with separation of duties, the three lines of defense, or so on? In my view, no. There is no problem with one department originating asset and another one managing the risk on them. The issue with the traditional approach to ILM is that the balance sheet that is arrived at often lacks a coherent shape or logic, and this makes this risk management of it more problematic. In the era of Basel III, it is evident that balance sheet management must become more proactive. So, quite simple, the discipline of ILM must recognize the asset origination and liability rising has to be connected. So for the ILM process to be fit for purpose for the 21st century, banks must transition and adapt from a transitional reactive ILM process to a proactive strategic ILM process which operate in a multi-dimensional balance sheet optimization ocean. And this is something on which we focus right now. So let's first of all explain the process of the matched maturity transformation of a bank, which is something which we're witnessing right now as a best practice for the funds transfer pricing and for the structure of ILM in a bank. So bank ILM works as a bank within a bank. So you see this, it sits in the middle between the asset center, which provides loans to clients, and liability center, which gathers funds from depositors. And ILM in this picture is working, gathering funds from the liability center and providing those funds to the asset center. So it manages the funding of whole bank. And there is the FTP process, which is a fundamental part of this exercise, because the ILM pays to the liability centers or recognize to liability center the FTP rate for those funds, which has been raised from depositors, and it charge the asset center through the FTP rate. So asset center is paying the FTP rate to ILM, which for the funds which it received. So this whole structure is, as you can see, integrated and based on the FTP rate and based on the FTP curve. So this is matched maturity because we see that business units in this model are immune to any financial risk. The exposure to financial risk in this picture is completely closed. And I spoke about this particular design in the funds transfer pricing webinar, where we have analyzed what does it mean, this immunization of the different business unit, and why it is necessary to transfer interest rate risk and funding risk to ILM, and also liquidity risk through LAB, through charging out the liquid asset buffer costs to business units, and why, and I will show some example how it has to be done, the methodology of charging out the call cost of liability to from ILM to business unit. It has been all analyzed in the funds transfer pricing webinar. So here I will only focus on to highlight that in this process we keep the business units immune to the interest rate risk and liquidity risk, and ILM keeps and manage the whole maturity transformation and interest rate risk exposure. There is also the FX exposure, the counterparty risk, and it is all managed in ILM. And as such, ILM is making some spread if it's working as a profit center. If not, this spread is distributed to the business unit through the certain process of distribution allocation of the ILM profit to the within the bank, if it is working as a service center. If it's working as a profit center, then this ILM spread remains here, and it is the profit of the ILM. So ILM here will be the business unit. So it's important, extremely important, to make this difference between the ILM which works as a service unit and ILM which works as a profitability unit. And then we have the commercial spread on the asset side, in this case, which is 2.69, and deposit spread, which here for the illustrative purpose is negative. And again, I explain all this when the product is value destroying, when the product is value adding for the bank. So it is obviously, I skip this part here and I will move on. We see again the maturity transformation, which is the main source of profit for the bank. We know that around 60% of the total net interest income is done through credit differential, but there is also 20%, around 20%, which is made through maturity transformation. It means that every single bank runs some maturity transformation. And in terms of the interest rate exposure, we call it riding the yield curve. So every single bank, to some extent, rides the yield curve and keeps some maturity transformation. It is some portion and the bank of the total net interest income of the bank, and the bank has its own appetite towards extent of the maturity transformation and towards the riding the yield curve in terms of IRBB exposure, which is definitely describe if in the IRBB policy, in the liquidity policy, and which is approved by the ALCO committee and board of directors. But it is important that we see how this maturity transformation here arise. So we can see that asset, retail mortgage in this particular example, has maturity of 3 years, and it is funded by a retail current account, which contractually has the maturity of overnight. So we can see this huge maturity transformation between the asset side and liability side, because the maturity of asset is longer than maturity of the liability. And within this, the FTP process slightly divides this profit, the total NIM, net interest margin of the bank. So it's allocated to different business units. So here some portion will be through FTP allocated to the asset center, some portion will be allocated to the liability center, and some portion is gained but by ILM. So without FTP, we wouldn't see this separation. We wouldn't see exactly how profitable are our asset side and products within asset side and within liability side, and how much ILM has gained for the bank. This is again the ILM, which is zero-sum game exercise, extremely important concept, because it is mostly related to the funds transfer pricing, because FTP has to be fair and transparent, and it is not supposed ILM is not supposed to mark up according to its own willingness, the FTP, which is charged on the loan, on the asset, and which is or marked down, for example, the FTP on the liability side. It is important that ILM is applying the exact FTP rate. So there is no gain and there's no profit which is made by application of the additional marks up and marks down to the FTP rate without any formal approval of ALCO committee or the strategic, as a plan of the strategic program or strategic exercise within the bank, because it obviously can happen, and then there is the markup on the FTP rate or markdown, so malus or bonus for certain products, but it is all decided at the bank level. It is not decided by ILM itself. So here ILM must work as a zero-sum game unit, so they don't earn anything through marking up artificially FTP on the asset side and liability side. This is meant by this concept, which for sure you have heard many times. ILM zero-sum game. It is quite common concept. And then let's start going through the different concept of ILM. So terms within ILM, like liquidity risk, interest rate risk, and effective balance sheet management. So what does it mean, effective balance sheet management? It basically answers the question, those different questions which I summarize for you here. For example, one of those questions is, are we borrowing too much from money market? So this is typical question which is put to ILM consideration. ILM has to answer this question. And will it run out of capital? Another question which is within the remit of ILM. How much do we hold as a buffer of liquid asset? And is it too much? Is it too low? This is again part of the ILM remit. Does our banking book, so does it meet all regulatory requirements. Obviously, it has to, but it is ILM task to make sure that, for example, liquidity metrics, IRBB metrics are within the limits. Risk management is the second line of defense, so they obviously will calculate those metrics, but they will raise hand when there is some risk of reaching those limit or threshold triggers. But basically, ILM has to be aware of those regulatory requirements, those regulatory limits. So when they undertake any strategy or hedging strategy or whatever funding strategy, they need to keep in consideration that they are outside their regulatory strict requirements, which the bank needs to abide by. And does it depend too much on swapping deposit in one currency to fund loans in another currency? A typical question which is raised by ILM, because obviously there is multi-currency world, and we have the material currency. Currencies, by material currencies, we mean the currencies which have 5% or more of total asset base. So it's quite significant. They have to be treated on the separate basis. So all analysis for the liquidity, for LCR, for NSFR, for interest rate risk has to be done separately for those currencies, material currencies. And then as far as liquidity is concerned, this is quite a good tool, which I would like to share with you, of optimizing the funding base based only on the qualitative approach. So we don't introduce here any quantitative approach, which we'll be introducing later. But here we see only on the funding base, which is optimized according to one criteria. And this criteria is LCR, and it is answering the question how much the certain funding source is LCR friendly. And you can see that the green part is indicating that the product funding is efficient funding and is LCR friendly. And the orange, yellow, and red color introduce how it is worsening. So different stages of worsening in terms of LCR friendly products. For example, we know that if we want to fund, this is the type of liabilities. So we have the senior, medium-term notes. Here we have the retail depot, so like CASA, current accounts, savings accounts, and time depot. So we can see that they are inefficient deployment of quality deposits, because obviously retail deposits are very good quality deposit. If we want, for example, to fund the cash through those funding, and or trading book, or a trading book financial institution asset with maturity, so volatile assets with maturity of lower than 1 month, it is obviously not good. And it's good instead, this is efficient funding as far as commercial asset and with maturity of higher than 1 year or equal, or even for the commercial asset with lower than 1 year maturity. So this is efficient funding. So here you have the asset side and different asset structure, asset compositions after asset categories. And here you can see the funding and answer. You can just answer looking for the different at the different point of this matrix. You can see, is it efficient or inefficient cost of funds? So this is typical, very good in my view, qualitative optimization of the funding structure. And many banks apply those qualitative approaches in order to optimize the funding structure. And then we have the interest rate risk side of the banking book.